Our next guest expects that to be the last one of the cycle. Goldman Sachs chief economist Jan Hatzius joining me now, Post 9. Welcome. It's good to see you.
Great to be here.
Fed's done, huh?
I think probably. I certainly think that September is pretty unlikely, even though Chair Powell was careful, not to say careful pace. I wouldn't expect a September hike. November is a possibility. I do think that the economy is going to continue to grow and probably continue to outperform expectations, at least as the Fed has laid them down in the summary of economic projections. But best guess is that this is it, and we'll be at 5.25 to 5.5 for a while.
When are they going to cut then?
We have them cutting very, very gradually starting in the second quarter of next year. Basically, inflation continuing to come down, the economy still holding up, but some concern about the real funds rate rising as inflation comes down. That's debatable how much of a negative impulse that would be, but I think there'd be some sentiment in the committee to ease very gradually.
You're suggesting that they cut not as a necessity because the economy has dictated that they must, but because inflation's come in enough that they can.
That's right. Our forecast is no recession, growth not too far from trend, but inflation continuing to come down as the remaining, supply chain issues and rent inflation in the CPI and the remaining labor market imbalances gradually work themselves out.
I mean, you've been sort of lessening your predictions for a recession to begin with, and rather steadily. Now, with the GDP report today, are you now firmly all the way in on soft or no landing?
Well, we've been in the no recession camp all along. We did take down the probability over the next 12 months further. We're now 20% probability. I would think of this as still a little bit elevated relative to your average cyclical situation. The average would be 15%, one recession every 7 years or so. But I think we're moving in the direction where it's no longer at all elevated, but at the moment, the labor market is still somewhat tight, and there's still some work to do.
Even though you think the Fed is not going to have to continue to raise rates because inflation's coming in enough, are you worried at all that they're going to go too far? That they still don't, in some people's minds, get it, and they're going to push it too far rather than just stop and see what happens?
Well, I think they're going to be data dependent. I mean, of course, it's possible that they make a move that ultimately they want to reverse. I guess I don't view it as that dramatic when we're talking about 25 basis points, on a 6-week horizon or 3-month horizon. I mean, we were in a world where they were going 75 basis points every 6 weeks. So that's, now it's really more fine-tuning. If they end up doing, an extra 25 basis points that they shouldn't have done, I don't think it's the end of the world.
Have earnings surprised you, even as, let's say, less negative you've been on the overall picture? They've held up pretty well. Surprising to you?
They've held up pretty well, and our portfolio strategist, David Costin, who you know well, has been saying that second quarter earnings looked like they were probably not going to be as weak as the market and the consensus at least was projecting. So in that sense, no.
How sensitive do you feel the market still is to rates and what other central banks are doing? BOJ policy meeting is tomorrow. I mean, the Dow's down 250. Rates are, moving a little bit higher today. The 10-year's back above 4%. The relationship between the two and how sensitive equities are to what happens in yields.
Well, I still think that the U.S. monetary policy and the drivers of U.S. monetary policy, especially via inflation and economic overheating, that is an important driver of the equity market. The BOJ, obviously very important for some markets. U.S. equities probably a little bit less so.